Hey, welcome to not Wine and Wealth, the closing beat. Happy Tuesday. How you doing out there? You see the bull over here is dead. Normally the bull looks like this, but we've got the bull on his side right now. So we'll just put him off to the side because he's trying to wake up. Hey, we're financial advisors here at Jazz Wealth, not your typical financial advisors, and we're experimenting with some things actually on the background here. Considering maybe some different offerings, and we try to do things different than the other financial advisors because they're boring, you know what I mean? Suit and ties and save all your money and budget for this and that and no Starbucks, and there's more ways to get there that the wealthy have opportunity for that I'm trying to fight on the background here to say, let's make that available for everybody. So we've got a number of things that we've done and a bunch of things that we're working on, but today we're talking about the stock market, and I want to try something different with you guys today. We've been a little bit busy lately, so I haven't had the best of data for you, but we're trying thinking about strategy a little bit. And I'm going to share an idea that I came up with. I don't know that it's good, but we'll just share an idea, see what you think, and maybe it's something we can include every now and then. Anyways, our FinTips this week is focused on inherited IRAs. Those are our free videos that go up every day at 1 o'clock Eastern Time on YouTube. They're free. All we ask for is a subscription. Maybe you hit the button, you hit the thumbs up. How hard is that? Like, really? You know what I mean? I think about it, too. I watch a video, and I'm like, thumbs up. That was a good one. Or if you think we could do better, we love ideas, inputs, criticism, just don't be vulgar. That's all we ask there. And anyways, let's talk about the stock. Oh, Wine and Wealth this weekend. Thursday, we're actually going to do it. We're going to talk about and share every ounce of data for every bear market there was, right? Because we very well, could be headed to a bear market. So we're going to cover every single thing. And I don't mean the general stuff that you see out online and stuff. I mean every single data point. That's where we spend our money here as we grow. Speaking of the markets today, what a range, man. Incredible range, kind of like the 92 Crossman drumline. They could play anything. Anyways, if we look over here for the day, kind of an interesting one. And somebody called it the other day, right? They're like, oh, man, yeah, we're up today. We'll be down 2% tomorrow. Hey, at one point, we were down almost 2% there in the S&P. We gapped down about 1% on the day. And that was interesting to me. So we have this day yesterday that was greater than 1%. And that's, believe it or not, it's quite rare to see a day that gains over 1%. Not lately, but that's pretty rare. Well, then for the next day to erase 1% right at the open, in other words, calling that a gap down, that's even more rare. So it was something that we wanted to talk about there a little bit. Anytime Monday gains more than 1%, but then we turn around and lose more than 1% on the open on a Tuesday there's only one other time in history where the stock market finished positive, and we almost did it today, right? Even after hours, we're only down 0.5%. Market's closed now, but only down 0.5%. The best performing time that happened in October 22nd of 2002. The day before was a Monday, and we gained 1.73%. The very next day, we opened down 1.24%, but finished the day positive. So we erased all that loss and turned positive by 0.5%. So that's about all the good news I have for you there, because in reality, here's every other time that's happened. And the numbers are a little small, but I'll read them off to you there. So being up 1% or more on a Monday, and opening down 1% or more on a Tuesday, there's the 5 other times that it happened. And what we're showing is the full week's performance, because this sort of thing happened on a Monday and Tuesday. So we said, well, who cares about the next day? Let's talk about the whole week and maybe look out a little further. Well, back in 2000, that happened. It was actually on May 2nd. And for the rest of the week, we lost 2.8%. It happened, I mentioned, in October of 2002. For the rest of the week, because we had that little rally there, we only lost 0.5%. If you go to 2006, we lost 3%, then 2%, then 2.6%. The average performance when the market is up 1% or more on one day reverses course on the open the next day. The average performance is actually a loss of 2.3%. So if we finish the week a little lower, you'd kind of understand that, right? These things happen. Stay with me. I've got a strategy, actually, I want to talk about a little bit. Before I do that, let's go into the markets today. Here's the S&P. The stocks that have the bigger weighting on the market not only were weak today, but made new lows. So Alphabet is a big weight on the market and hit new lows. But notice it recovered off of lows. That was part of what helped the market try to rally throughout the afternoon there. If you look at something like Amazon, it made new lows as well. Big weight on the market, but that started to recover. In other words, people are fishing for a bottom with more money than they've been fishing for lately. That goes to be the same comment there on the S&P. They're fishing for a bottom somewhere around a 20% decline for the moment, and now we actually have real money going towards it there. So it's kind of interesting to see that. Generally, today, people wanted to selectively buy discounted dividend stocks. Occasionally, I share like a decile analysis. We get kind of crazy. If we were to run that for today, you would find that the discounted dividend stocks lately were the ones that have performed best today. So look at Verizon, AT&T are some of the obvious ones. AT&T not so discounted. Walmart recovering a little bit here, right? That's a dividend discount stock. Procter & Gamble, boring, steady companies that just do their thing. Coca-Cola's erased more than half of its decline from the other day. Remember, consumer staples took a big hit. So generally, if you don't want to look at stocks, consumer staples there, they took their shot today, not too bad. If we look at the NASDAQ, so the NASDAQ is getting close to down 30% year to date there. Didn't participate today really in any meaningful way because you've got big tech. And let me come over here and do this with you here. We got big tech lower on the day. That'd be your Netflix. You know what I mean, right? When I say big tech. Netflix down 3%, almost 4%. Tesla down as well. I'll throw Starbucks in there as well. Facebook down 7.6%, really thanks to Snapchat there. So you had the big tech stocks refuse to get anything done. You had the Chinese names, which tried to rally a little bit there towards the end of the day, but China had a bad night overnight. JD.com, China name there, down 7% on the day. Baidu almost down 7%. Where's Pinduoduo? I missed it somewhere. It's in there. Oh, there it is. Down almost 9% on the day. And so big tech with the Chinese stocks a little bit lower. And I'll throw in semiconductors couldn't get out of their own way today. They had a chance to participate. Look at NVIDIA, QCOM, AMD, Texas Instruments, Micron. They all had a chance and couldn't get it done. Analog Devices was the only one that really finished the day positive off of a fairly impressive lower move to start the day. Large cap growth, right? Large cap growth was the second largest losing factor of the market. Growth, value, index, core, you get what we're saying there. Small cap growth was actually the worst performer today. So small cap growth actually was down 2.4%. Growth in general, no matter what the size is, was the worst performing area. So that definitely hurt the NASDAQ as well. If we look at the Dow real quick and then we'll move on, it actually finished positive on the day. So the Dow finished positive thanks to the really boring names. And that's just the kind of day it was, right? Boring names, McDonald's. When do you think oh, that's exciting, let's go invest in McDonald's? You don't, right? Nobody's thinking that these days. Verizon, IBM, I mean, for God's sakes, IBM, 2% gain on the day. It's not very exciting. It's not the type of stock you look at. Coca-Cola, Procter & Gamble, and then I'll throw in JP Morgan as well because the banks have really started to say this is it. Interest rates are helping us. Net interest income is wider. You know what net interest income is, right? Net interest income is the difference between what they loan for and what they borrow for. So a widening of that spread is good, means more profit. Well, hopefully means more profit for them. So that was kind of what's happened there, and I touched on some sectors as well. Nonetheless, the Dow finished positive. It's only down 12% year to date, which I think a lot of you would take, right? Also, new home sales came out today, earlier this morning there. New home sales down 15%, and the home builders kind of nailed that one, didn't they? I mean, I think they're going to find themselves a little bit behind, but remember a couple quarters ago, home builders said, we're just not going to build for anymore. We have enough demand. We've got enough stuff going on. We're having a hard time getting parts, supplies, and labor. You know what? We're just going to build out what we have and go with that. Hold on to some of our land and stuff for future development. Well, smart by them. The median home price, I believe, was like $450,000, $430,000, somewhere in there. Well, that's 20% higher, so a little inflation there as well. And inventories are starting to drop off just a little bit there. So, maybe they didn't do too bad. That wasn't a bad thing for them. All right, let's try something. So, over the summertime, investors look for ideas to test new strategies. Typically, the summertime is quiet. I don't know if this summer does it, but typically summertime is quiet and people say, let's test some new ideas. So we may do this a couple times. Think of Dogs of the Dow, for lack of a better thought off the top of my head. So Dogs of the Dow hasn't really outperformed the Dow lately, but historically outperforms the Dow, and that's what people like to look at there. But you got to do that at the beginning of the year. Well, somewhere along the line, someone came up with that as a thought. They tested it and said, I'll go with this, right? So over the summertime, it's a great time for investors to say, well, what if I buy this group of stocks this time of year, mix them with this or that, try different ideas? And it's not as easy as saying, well, let's just, see how many breakouts, do well at the end of the year versus the beginning of the year or something. You want to get a little creative here. So I want to give you some ideas. Typically, I hear from people throughout the year that say, it's summertime, I'm testing some new strategies. Can you help me with the data or something like that? All right, here's what I've got. Yeah, I'm ready. So there are 11 sectors in the S&P 500. And every year there's good ones and bad ones. They don't all move exactly the same all year long. This year's a great example because energy's up 50-something% and consumer discretionary is down 30%. There's an 80% spread between the best performer and the worst performer. So here's an example of visually what that looks like. So back in 2020, here's September 2020 to February of 2021. So we arbitrarily just say, pick so many days, right? You can say, 50 days, 3 months, 6 months. Let's look at a time period and let's say if there's a wide spread between two sectors, the best and the worst, how wide was that spread and what happens going forward? In other words, do sectors like to stay spread apart from each other or do they eventually converge? And if they converge, is there a way to make money on that? Do you buy the weak one? Excuse me. Do you buy the weak one or do you sell out of the strong one? What's the strategy there? So this is what I'm talking about. 67% higher over this time period, or there's a 68%, 69% spread between the two. So what we did is we said, is there something there? Can we somehow strategize wrapped around that? Let's take a look. So if we were to do that and take a moment in time, just throughout the year, whenever there's a wide spread, and by wide spread we mean over 50 percentage points, if that were to happen, what is the performance going forward of each sector? So for example, in the last one that I just shared there with you, I'll pop it back up so we can see. For example, we have at this point in time, energy and utilities, best and worst, with a wide spread of over 50 percentage points. If that were to happen going forward, what would be the performance? In blue, we have the best performing sector, forward performance, and then in the black, we have the worst performing sector. So in this example, we would say, all right, going forward, the best sector only gained 3%, but the worst sector tried to recover and participate with the best to the tune of 12%. Hey, there's a lot of you that would take 12% right now. That's over 3 months. Over 6 months, same thing, just a little bit muted. And over a year, that's not a bad place to look. That's not a bad strategy to say, well, let me position a little bit here when I don't have any other ideas. So if we look at the percent of time that the sectors were actually positive, the best sectors 3 months going forward were positive 60% of the time, 46 months, and 1 year later, 80% of the time they were positive. But we know that it's not better than the worst. So that's nothing to laugh at, the 10% there, but we know it's not better than the worst. So as long as this performance of the worst sector is not just randomly positive, if there's some consistency to it, we may have a strategy here. So if we look at the worst sectors going forward after a wide spread, 80% of the time they're positive over a 3-month time period. Go out 6 months, 60%, and go out 1 year, 80% of the time you average an 11.2% of the return. Right? 60% of the time, you average a 6.8% return. And 80% of the time, over 3 months, you average a 12% return. So in other words, when there's a wide spread between the best and worst performing sectors, look at the worst one. There may be something there. Currently, our worst performing sector year to date is consumer discretionary. And like I just mentioned a minute ago, that's the city calling me. That's interesting. I just mentioned a minute ago, consumer discretionary is the worst performing sector. The spread between the best and the worst performer right now is 50, 60, 70, 80, 85 percentage points. That's greater than 50. Well, we just studied what happens when the spread is 50 points or more. So could that mean 3 months from now, there's an 80% chance that consumer discretionary is positive? It's not easy to wrap your head around that because you think the world's about to end and all that stuff. Could it mean a year from now, there's an 80% chance that it's positive, right, by double digits? So I'm not trying to point you to doing this. I'm trying to point you to recognize when something's a little odd. And last night, or as I was thinking about this, what stuck out to me was energy and consumer discretionary are oddly spread apart. Energy in particular, right? So we know now that energy has a good probability of being positive, but not by very much going into the rest of the year. And we know that consumer discretionary, XLY I used in this example, has a greater probability of gaining more in terms of total return. So that's my idea wrapped around strategy. Let me know what you think. Maybe I was way off and that was super boring to you guys, but I just wanted to throw something different out there that took quite a while to put together, but we could do that every now and then. There were 7 new highs today, 41 new lows. Utilities were in the new high category, which is different, right? Utilities sort of broke out. There's not a lot of breakout type patterns here, but here's Xcel Energy. Broke to new highs and finished at the highs of the day, so finished really strong. WEC Energy is the same thing. Notice that it broke to new highs and did not pull back. Often that happens when something gets a little too extended during the day. This actually managed to stay at highs, so not too bad there. If we start looking around at some of the new lows, the ones I'm interested in, or that I think are most interesting, are those that are extended. So they sold off and made new lows today. Interpublic Group's advertising company. And all of a sudden reverses course, almost makes its way back to positive, but that was too big of a move lower today. So things like that, you look for more follow-through on any pullback. Technical traders would assume that that is buyable. Royal Caribbean's the same thing. It just did not reverse course today. Quite weak, actually, Carnival and Royal Caribbean. But now getting really extended. So things that are making new lows and getting extended with the market being extended to the downside, maybe something interesting there. Advanced Auto Parts was still down on the day, but this got a little bit of love from AutoZone, which had their earnings. Come to find out, people were just fixing their own cars, not buying new cars there. And so that was something interesting that we caught there. And I'm going to play with a new way of sharing this kind of data with you as well. But for the moment, that's where we stand. All right, let's go on to stocks in the news, and then I will take your questions if you have any. First up, we got Best Buy. So I'm going to go a little more detailed with this one today. Got a little extra rest yesterday. So Best Buy, these guys focus, they sell basically electronics in one fashion or another. What's interesting about this is Target's earnings the other day said, we find that our shoppers are moving away from electronics and they're moving into other maybe back to school kind of things, not quite, but like clothing and kids' clothing and things like that. And so if that were the case, broadly, then you would expect Best Buy to go, oh no, people are moving away from electronics. Well, that's our whole business, so we've got some problems there. They actually guided for revenue of about $49 billion. That's $1 billion less than they were expecting, but who's counting? Total store sales should be down about 4.5%. Margins are going to be down to about 5.3%. So they said, we're just going to buy back stock, $1.3 billion worth of stock. That's close to 10% of their entire value of the entire company there. The dividend stays the same, for currently a yield about 4.8%. Online store sales were down, right? 14.9%. They fell, which means what? We're going out and just buying the stuff at the store. It gives you a hint about retail sales numbers when they come out there. Computers and home theaters were the first to decline. Well, gee, do we need a home theater if you think the world's going to end there? So kind of interesting for Best Buy. But overall, investors like that there because their guidance going forward was not quite as horrible as everybody else seemed to point out there. So I thought that was interesting for you. And I don't know, worth diving a little bit deeper into it there. AutoZone, AZO. So they had earnings, a great day for them. Like I said a minute ago, people are just fixing their own cars, choosing to do the repairs locally, as well as the commercial auto shops, buying more from AutoZone because people are just getting their cars repaired. They're not interested in going buy new cars anymore. And who could blame them? It's expensive. Snapchat or Snap Inc., you probably saw the news, right? They just had nothing good to say. This is their worst day ever. 43% down in one day. There's no data to say, what happens tomorrow? We don't know. This just never happened there. You got Uber in the news here as well. They have officially stopped all hiring. So they scaled back a couple weeks ago. They have stopped all hiring. They're not firing anybody yet, but they are stopping that. I believe Lyft came out and said the same exact thing, no new hiring for them, which is tough because how else are they going to make any money? I don't know. That's not my problem to solve. Zoom beats easily on earnings there. It trades within the expected move. We talked about that yesterday there. Guidance going forward, well ahead of everything that was expected. Stock was higher and all that good stuff. I made some notes here. They had revenue. By the way, Zoom is a very low debt company. So from a balance sheet perspective, I get that the stock is beaten to death here, but from a balance sheet perspective, there's almost no other company in their category or even in their tech space that has a balance sheet like theirs. Very, very low debt. They've got a whole bunch of new things going on. They got revenue of $1 billion thanks to success from Enterprise, Zoom Rooms, Zoom Phone. I actually don't know what that is. And they're happy with profitability at the moment and all that great stuff. What do I have for you here? All right, customers contributing at least $100,000 annually to Zoom, nearing 3,000. So that's up 45%. So that part, very, very good news. Companies with greater than 10 employees, because obviously they make money the more people that use it, 502,400, that's up 1%, not a very big deal. Enterprise customers approaching 200,000, that's up 24% there. Very interesting. I found interesting in their earnings report there, adjusted free cash flow margins. Those are down about 1% because of the way they're paying people. They more than doubled their stock-based compensation plans. I didn't know that. So very interesting there. If you work for them, you're likely being rewarded with some really cheap stock at the moment. They're doing a $1 billion share buyback program there. They've already done $132 million. They got $868 to go. Remember, these guys, not attractive stock at the moment, but very, very, very well run from a balance sheet perspective there. So I don't know, just some interesting things that maybe you find boring or maybe you've already heard it. I don't know. Tomorrow you've got earnings from Dick's Sporting Goods. What else do we have? Box, Splunk, NVIDIA, Guess, and Williams-Sonoma. Snowflake. Did I say Snowflake already? And kind of a mixed bag all across the board there. Splunk has the worst performance, down 6 of the last 8, so not good for them. You got Jerome Powell speaking tomorrow as well, so that's likely to get attention. Very much so there. All right, we'll let the stream catch up here, and then I'll take your questions and go from there. Is Zoom a buy? That's a tough one. You know what I mean? You look at the stock and you're like, why do I want to be the one that guesses this is the bottom? That's my first thought. Why do I feel like this is the moment that it's going to bottom? But I like the company themselves. They're not your typical tech company that's like, well, figure out how to make money later. No, they make money, and apparently are very good at keeping their debt low. Yeah. There we go. Am I hiring? Sure. Anybody want to teach us how to do all this video stuff? That's a weakness for us. Yep. You were holding 50 shares of Snap at 49 today, about 20 more at 1380. Thoughts for 6 months, 1 year, long term. Whooped in the face. Punched by 10 Mike Tysons today. I mean, that's a horrible, horrible day there. I don't know. Yeah, good for you for getting a little discount there. Well, severe discount, but I don't know that I would be going too heavy in Snap for right now. Right? You're definitely going against the grain, and I like that. I'm a contrarian myself, but I don't know about that one. Lucas, starting to think you made a mistake. What, you're just starting to think that? You're just now coming up with that? No, yeah, you're right. Nobody wants to play with any stock that was already weak ahead of the market weakness. You notice that? Any stock that had already been sold off, your COVID stocks, kind of things. Zoom is a great example. Already beaten down. Nobody wants to assume that that's a good place to be right now. That could change, but you're right, Lucas. Not looking too good at the moment. I should have went with SQM as the top pick. Yeah. You think Powell's really good about that, actually. Jerome Powell is really good at just saying what he needs to say. He very rarely trips over his words. He very rarely says something that contradicts himself. He's pretty good at that. Give him that. Evan wants the job. You know, video man. You get us into something a little more fancy than what we got. Some days it's like, this just barely works. I mean, it's like my toes are always crossed, man. Yeah. How can we learn to be contrarians in your investments rather than with each other? Oh, you mean like politically or something? People like America? Yeah. I don't know. I'm not sure what the question is there. Any takeaways from Dole's? Yeah, so actually a lot of those in that space, that consumer staple space, they were hit recently, but almost none of them have had this kind of response that Dole had today. Their focus was on guidance going forward with all their increase in costs, right? Because they're dealing in perishables, so it was a whole different game there. I didn't know. I like to read about this stuff, but I didn't know you guys were focused on those kind of names. I could go outside the box too. I mean, my favorite thing is small caps. I mean, we could talk about that kind of stuff all day. Is that interesting to everybody? I don't know. It just seems like if you don't say the word Tesla once a day, you know, the algorithms think you're talking about nonsense. Home builders are slowing down, well, from a company perspective, right? So they started that a couple quarters ago, saying the risk for them is to the downside, that they were going to try to get higher margins on the house and houses under contract that they already had. They pretty much all unanimously agreed to that. Yep. Yeah, there's a difference between a contrarian day trader and a contrarian investor, right? And they would just say value probably at that point. Big difference, right? The longer you have, the better off you are. Tough to be a contrarian day trader. Teach you about biotech. I mean, I know some people that could, but it's not me. Anything medical, and my brain just falls asleep, man. I don't know what it is. Yeah. I'll tell you, though, last night, stepped up. I was a good man. The wife had to take a shot. She got pneumonia. And so I had to, you know, I'd never given somebody a shot before. And she said, just go for it. And I can't say I'll do it again, but me and needles, you know, we don't get along. I just kind of closed my eyes. But I got it done, man. I stepped up. You know what I mean? You get bit by a jellyfish, I'm there for you. Cody, you know what I mean? Are you over there? I can't even see you, man. You get stung by a jellyfish, I'm there. That's the kind of guy I am. Well, I think that's the protocol. Yeah, I think you're supposed to. You need a shot, whatever, you know, I'll suck it up. That's probably, that should be like the message of our company. Jazz Wealth. You get stung by a jellyfish, we're your guy. Yeah, well, I should stop now, he says. So we'll just wrap it up there. Okay, enjoy the rest of your day. I got a birthday party to go to tonight. I got invited to a birthday party, and I'm like, oh man, do I dress up? How's this gonna go? So I gotta go do my thing, but you guys enjoy the rest of your day. There will be no closing beat tomorrow. It is Daddy-Daughter Day for us. We try to do that once a year or so, and so we're gonna do Daddy-Daughter Day. We'll be back on Thursday, of course, to do this all over again, and you guys enjoy the rest of your day. Thanks for watching.